Good afternoon, everyone, and welcome to today's webinar, Retirement Tax Strategies During an Economic Downturn. My name is Lauren LaFurla, and I'm the Director of Communications here at Covism. I'm joined today by our speaker, Joe Alsasser. Joe's a certified financial planner and the founder and president of Covism. Under his leadership, Covism has developed a variety of groundbreaking financial planning tools, including Social Security Timing, which was the first patented Social Security optimizer, Tax Clarity, Smart Risk, and Income Insight. Joe co-authored Social Security Essentials, Smart Ways to Boost Your Retirement Income, and is a regular contributor for USA Today, Investment News, Retirement Daily, CNBC, and Think Advisor. Joe also maintains a financial planning practice in Omaha, Nebraska, doing the very things he'll talk about today. Our topic today is retirement tax strategies during an economic downturn. You should see a button labeled Q&A. If you have a question, please type it in the box and we will address your questions at the end of the presentation. Just a reminder, we will be recording today's presentation and you will receive a link to the recording in your inbox later today. Thank you for attending, and I'll turn it over to Joe.
Thanks, Lauren, for the intro, and thanks to everyone who's on the meeting today. Retirement tax strategies during an economic downturn. Probably should have called it retirement tax strategies during a market downturn because it's interesting. It's just so interesting, whether we'll find out that we were in a recession longer or shorter, or maybe we don't touch a recession. I think we're likely to touch a recession. But really what matters to our clients is less about what's happening. When I say our clients, I mean specifically clients that are on the cusp of retirement and transitioning through retirement. It's really probably less about the economic downturn than it is about the market downturn. It's about the impact on the assets that are necessary to support those clients' retirement incomes throughout the rest of their lifetime. So today, we've got a pretty full agenda, but please do ask questions. Please pop those into the Q&A box and we'll address those as we can at the end of the presentation. So we're going to start with just kind of an overall state of the markets. We'll talk about 5 specific tax challenges, and I'm willing to bet you've encountered probably every single one of these with a new client at minimum, and maybe some with clients you've had for quite a few years that have had challenges that have just been too difficult to exit from, too much pain on the way out. We'll talk about how to spot tax opportunities, and then we're going to close with a couple of specific case studies that are particularly pertinent right now. So let's start out with state of the markets. I imagine that every day when you are looking over your clients' accounts, you're seeing, client accounts down. And if we look at the stock side of the portfolio, I use these two indicators as overall indicators of asset classes. So we tend to use SPY and AG, SPY for stocks and AG for bonds. Of course, there are pockets of outperformance, pockets of fantastic performance like energy. When you've got FANG stocks making up a huge amount of SPY, this is the kind of result that you see. So year to date, down 16. Bonds, down 15%. This has not been a year where bonds have buoyed the stock sides of portfolios. So, for us, and I'm sure for many of your clients, it's not uncommon to see 10, 15, 20% down through the course of the year, given what markets have done, or maybe more accurately peak to trough. One of the things that I do like to look at is the Morningstar Fair Value Index. I don't know if you've ever seen this, but the site is down at the bottom. And basically, this is a compilation of all of the listed stocks, all the stocks that Morningstar analysts actually follow relative to their current trading price. So you'll see periods of overvaluation. You look back to last January and you actually saw a fair value indicator well over 1, and 1 represents right at what their projected fair value was. Since then, you see this, kind of jagged but generally downward trend. And that's the interesting part about a market downturn, right? We've all seen this. Many of you on the call probably seen it many times throughout the course of your career, right? The challenge with market downturns is you never know when they're going to end, right? You never know when that bottom is. Sometimes there'll be multiple points that'll seem like a bottom. You'll have clients calling, and of course, we never know until after the fact. And that is actually one of the biggest challenges in implementing a financial plan during times of market stress, is we don't necessarily want to be in a position where we're trying to time the market. At the same time, maybe we don't want to make an aggressive move when the market is at an extreme. So for example, if I were looking at doing Roth conversions and I knew that one out of a 5-year period, I would expect to do one large conversion. But this year, let's just say that fair value index was way over one. We're really highly valued. We look back 2 years and that might have been the case. Maybe that's a time where we have that be one of the 4 years of normal conversions. And maybe a time like this is a time to do that larger conversion. Those are some possible considerations. We're going to talk about some of those things later in the presentation. Now, one last indicator that's interesting, it's the Fear and Greed Index. I'm not sure if you've seen this, but the Fear and Greed Index put out by CNN Business, and it's updated every day. And basically, it's 7 factors that look at what the overall sentiment of the market is. And it's designed to be a contrarian indicator. So in theory, the idea is to sell when others are greedy and buy when others are fearful. And if you just look at most recently, we've been in that kind of greed range. And if we right back to the fair value chart, we can actually see that trend. And if we look back a month ago, we were in the extreme fear index. We look back where that was at. These two tend to track relatively closely over time. So right now we're in a state of market turbulence. That might be the easiest way to put it. We don't know how far in, we don't know how long it'll last, but we do know that we're not in a happy-go-lucky, actually for advisors, what I would call a scary time where markets are overvalued. We expect that we're not in a dramatically overvalued kind of situation. If anything, we may be in a significantly undervalued sort of market. So let's talk about some of the tax challenges that we frequently see as advisors. These 5 tax challenges are challenges that we've got to deal with. Let's say we've got an incoming client. We're probably going to deal with at least one of these challenges for an incoming retirement income client. And we can't always solve them in one fell swoop. So here are 5. The first one is concentrated low basis positions. How many times have you had a client walk in with, for example, Microsoft that they bought 20 years ago? And we would love to be out of that position because we've got way too much of it relative to their overall net worth. You laugh, but I'm here in Omaha. It's actually more frequent than not that we will see a lot of Berkshire Hathaway in client portfolios. This is Woodstock for Capitalists. It's held here in Omaha. That's the Berkshire annual convention. So it's not uncommon at all for us to see highly concentrated, low basis positions that people have held for a very long time that really represent a high area of risk for an overall financial plan. So first challenge, concentrated low basis positions. A second challenge we frequently see is poor or no asset location. And by asset location, I mean in which accounts are we holding which investments? So for example, if I've got a client who has the simplest account structure possible, each of the members of the household have an IRA, have a Roth, then they have a joint non-qualified account as an example. So 5 accounts, that's quite possibly the simplest overall account structure for a married couple. And they have the same portfolio across all the accounts. Or worse, they've got something really conservative. They got all their bonds in their Roth, or they hold annuities in their Roth, and they've got stock positions in their IRAs. Whenever we see something like that, we know that they've either got no plan at all for asset location or some really upside down ideas as to how that could work in their favor. A third tax challenge is investments misaligned with risk tolerance. And the reason I put this in the tax column is because during a highly valued market, it's really tough to undo, right? We don't want to take a big tax hit in order to get them where they should have been in the first place. Ideally, we'd be managing it over time so that we don't end up in that spot where, oh my gosh, we look out there and the yard is 1.5 feet long. It really needs to be mowed, but it's really a terrible time to do it. So when we see those situations where clients have investments that are horribly misaligned with risk tolerance, but we're in a really strong market where there's a lot of gains in a lot of those positions, it can be a little bit paralyzing. We may want to cut some of the call them either too high or too low risk positions, but we might want to be cautious about how much of those we cut in 1 year and maybe create a multiple tax year transition plan to get them where they need to be. A fourth tax challenge is a poor or no planned harvesting pattern. Now, we're going to talk a little bit later about the difference between what we might call tactical solutions and strategic solutions. This idea of a harvesting pattern is an overall structure of which account do I plan to use at which points in retirement for retirement income. And if I start to think about it that way, then it really gives me a structure into which I can invest those assets in a way that is pegged for their time horizon, for how long I expect to hold those assets. And it makes asset location an awful lot easier. And the fifth is excessive 401k balances relative to need. How often have you seen that situation where the client has saved almost exclusively in 401k assets, and frankly, they don't have a high lifestyle need to live exactly how they want to live. So when they hit 70 and a half, now 72, all of a sudden, their withdrawals are far more than they need from the 401k or from the IRA because they have to be, right? Because of those required minimum distributions. And as a result, we have this situation where they're paying a much higher rate than they should have paid had they planned for it in advance. So those are 5 tax challenges that we're going to address through the course of the presentation today. In order to do so, though, we've got to be able to have some kind of framework for spotting when are these tax opportunities present, right? It's not just the marker of, okay, we've got this market environment, everything's undervalued. Does that mean there's a tax opportunity or not? We don't know, because it's not just about what the market is doing when we're thinking about financial planning in this way. It's also about what does their overall income picture look like and how does it work together to create tax opportunities or to put us in a situation where we really have to watch out. Maybe it's more about avoiding some tax pitfalls. So let's take a quick pause there for a poll. We're asking whether you currently use Covisum software. There are a lot of you on the call today, and this will help us kind of gear how much time we spend working through the visualization part versus working through some of the opportunities. Okay, gotcha. So we've got a pretty even breakdown of both. Wonderful. It looks like we've got a lot of people still voting. So, all right. Thank you. Thank you for everyone who voted. So here's kind of how that broke down. We got quite a few in each of the categories and quite a few people voting. So I'm going to spend a little bit of time talking about tax brackets and how we visualize them, because that's going to really help you understand maybe a little bit better how we visualize those opportunities. I'm sure every single one of you has seen a table like this. This is the married filing jointly brackets for 2022. So we see basically it's a progressive tax structure. When you have lower taxable income, 0 to 20,550, you're paying 10% federal income tax. 2551 to 83,550, 12%, and so on and so forth. So as taxable income goes up, ordinary income tax as a percentage goes up. Now, this is how we visualize that. So the idea is, as I move to the right, I'm adding ordinary income. So first I see 10%, and only the dollars that fall into that bracket are taxed at that rate. And then I see 12%, et cetera, on down the line. So when we hear people talk about tax planning in retirement income, what we really hear a lot of is maximizing the bracket. Let's make sure we take advantage of everything we can that's at 0%. Or let's make sure we fill the 12% bracket, or let's make sure we fill the 24% bracket. And the reason is because each of those represents a big jump. So if I would normally sit here in the middle of the 12, but I can get some more money out of an IRA at the 12, maybe I want to do that to keep money from landing in the 24 or higher later on in retirement. So that's in concept, the idea of maximizing the bracket when we're doing retirement income planning. And this is how we'll visualize it throughout the presentation today. You probably noticed on this tax map, in our prior chart, the 10% bracket started at $0, but that's not really how it works, right? The way it really works, it's shifted over. And why is that? That's because of the standard deduction. So that's what pushes that 10% bracket over to around $28,000 this year for a married couple filing jointly. Now, we also have separate capital gains brackets. So for taxable income from 0 to 83,350, you're actually paying a 0% capital gains rate. For taxable income between 83 and change up to 517, it's 15%, and above that, it's 20%. Now we'll come back to the net investment income tax because an awful lot of people in this range aren't paying 15 or 20, they're paying 18.8 or 23.8. So this is what that looks like in a map, right? We've got 0% up to about 112 and change. Then we get into the 15% capital gains bracket. Then we get into the 20% capital gains bracket. Now, of course, for retirement income, we've got to pay special attention to Social Security taxation because a good chunk of our clients are going to have taxable Social Security income. And considering how many of you are subscribers or considering subscribing, I'll probably take a quick pass at this. Remember, only half of the Social Security benefit goes into the calculation. Then ordinary income, then dividends and capital gains, then you add in non-taxable interest. So this makes provisional income. Then we apply some income thresholds to our provisional income number. And for every dollar that is over the first threshold, 50 cents of that dollar becomes taxable as ordinary income. And every dollar over the second threshold, 85 cents of those dollars become taxable as ordinary income until we reach the maximum taxable amount, which is 85% of the total Social Security benefit. So here's two quick tax examples. First one is $40,000 of Social Security with a $20,000 IRA withdrawal. So we take half the Social Security benefit. I can't stress this enough. If you haven't heard it enough, then I'm going to keep stressing it. $20,000 of Social Security plus $20,000 IRA withdrawal gets us that $40,000 provisional income. Only half the Social Security benefit went in. We then apply our threshold. So this is a married filing jointly example. $8,000 over the first threshold for total taxable Social Security of $4,000 on $40,000. So in this case, they've got a $60,000 income in this household, and only 10% of their Social Security benefit is treated as taxable income. In the second example, we flip it. We say $20,000 to Social Security with a $40,000 IRA withdrawal. So we take half the Social Security, add it to the IRA withdrawal. That gets us 50K of provisional income. We're 18 grand over the first threshold for 9 grand of tax, because 50 cents on the dollar is taxable over the first threshold. And we're $6,000 over the second threshold at 35%, because we already picked up the first 50% over here for an extra $2,100. So in this case, the total taxable benefit is $11,100 out of 20 grand, 55%. What's different here? Really, what's different is the concentration of Social Security income versus IRA withdrawals. So it's really all about blending those income sources in order to create real tax efficiency. So look at this. This is once we bring it onto the return. So our first example, 40K of second example, 40K of IRA, 20K of Social Security. Take our taxable Social Security, add it to our IRA withdrawal, subtract out standard deduction. That gets us federal income tax of $2,200 and change. In this case, we actually have considerably less taxable income than we do standard deduction, which means we could actually take more money out of the IRA and still pay 0 federal income tax in this second scenario. We also have to worry about Medicare premium surcharges. They're not technically a tax, and it's really 2 years in arrears. So these are the 2022 premiums. They're based on the income that was on the tax return in 2020. But really, they're a tax. They're targeted in exactly the same way tax is targeted. And so we have this really significant amount of additional Medicare premiums that our clients can be subject to if they're higher income earners. Now, this is probably an area that you've seen. Maybe you've seen it. Maybe you've seen it without knowing you were seeing it. And that's oftentimes the situation for these spots where capital gains become taxable based on other things that are happening, not just the capital gains. So here's an example. We remember when we added our standard deduction to our capital gains brackets, we can actually, if we only had capital gains, we could have $112,000 of capital gains and pay 0 federal income tax. And that's this first example. If we had 100K, be completely tax-free. But let's add a $28,000 IRA withdrawal. Of course, that's going to get wiped out by the standard deduction, right? $28,000, 28.7 was our standard deduction for a married couple. So that's going to wipe that out. But what happened is it pushed some of this capital gain out of a 0% capital gains bracket and up into a 15% capital gains bracket. So even though my ordinary income didn't create any tax on ordinary income, it actually created some capital gains tax. Now, in this last scenario, let's say that we had $50,000 of ordinary income. You can see that really push both above the line for the standard deduction. So now we have some ordinary income that's taxed at the 10% rate. And we're also pushing a much larger chunk of capital gains up into the 15% capital gains bracket. And then finally, this is the last one I'm going to touch on. This is the 3.8% net investment income tax. And this is on specifically adjusted gross income over 200K for a single or 250 for a married couple. And it applies to an awful lot of things, capital gains and dividends being the most common, but annuity payments, interest on CDs didn't used to matter. It might matter going forward. If we see interest rates continue to stay as high as they are now, that's going to go back to being in the it matters, we have to pay attention column. Passive business income and rents also fall into that. Why did I just go through all those tax rules? Because really what we need to be thinking about as we're doing retirement income tax planning is effective marginal tax rates. It's not the bracket that matters. What really matters is how much do I actually lose to Uncle Sam on my next action, okay, on the next dollar I take. Because in theory, I can decide to take $1 or $2 or $3 or $4 up to the total account balance. I can make any of those decisions. And so really, for me to decide how much I should take from a variety of different accounts, I've got to look at this idea, the effective marginal tax rate. How much do I lose on each additional dollar? So here's a quick case study. The real tax system, married filing jointly, both 65 plus. We've got 61K of combined Social Security, so at least one of them delayed. We've got $10,000 of net long-term capital gains and 52K of IRA withdrawals. This is what the tax map looks like for them. We introduced the red earlier. The gray is what actually happens on the next dollar. Once you account for the interactions with all the different income types. So in this case, once they get about north of just about $10,000 of IRA withdrawals, they start to experience an 18.6% effective marginal rate. If you work that out by hand, you'll come up with 18.5, but the way the tax brackets break down, it actually rounds to 18.6 for this case. So what is that? That's $1 of IRA withdrawal that pushes 85 cents of a Social Security dollar into taxable range as ordinary income. So that's $1.85 that are getting taxed at a 10% bracket. Then we step up to the 22.2. What's happening there? That's $1.85 times 12%. The surprise for a lot of people, and actually a seminar attendee I had maybe 10 years ago said, what's that finger there? And that finger is a client who at the top of their tax return will probably tell them they fall in a 12% tax bracket. You trace that down, most of that falls into a 12% tax bracket. is actually losing 50 cents on the dollar on this chunk of their retirement income to federal income tax. You might say, how does that happen intuitively? Yeah, they fall in the 12% bracket. I would expect a 12% tax rate. I'd expect $120 a tax. But what actually happens is we do get that 12% tax, $120 of ordinary income tax, but then it pushes $850 of Social Security into taxable range, which also gets taxed at a 12% bracket. So now we're up to $102 additional, which then turns around and pushes $1,850 of capital gains out of a 0% capital gains bracket and up into a 15% capital gains bracket for a total of $277.50 of additional tax. Add it all up, and it's about a 50% effective marginal rate on that $1,000 withdrawal. Same thing can happen in capital gains. So this would be a situation where, for the first 15,000 or so of capital gains they harvest, they're experiencing a 10.3% effective marginal rate. But then on a chunk of capital gains, they're actually experiencing 38%. And why? It's because if we took those capital gains off, we'd have less taxable Social Security, which in turn would turn around and take more capital gains off. Yes, it's odd and circular, but that is in fact how it works. So the reason to go through the effective marginal rate concept is because there are tax opportunities anytime we see those spikes in effective marginal rate, because that means that we either have an opportunity to avoid it or to make sure it's not happening in the future, or to get below it. So we can either go right or go left. And that's why I mentioned we can really think of these two groups of tax challenges, right? What are the tactical tax challenges? They're concentrated low basis positions, poor or no asset location, and investments misaligned with risk tolerance. And I put those in the tactical category because we can handle these a chunk at a time when opportunities present. And market declines can really provide tactical opportunities to resolve those tax challenges, right? If I have concentrated low basis positions, what can I do? I can sell another position for a tax loss. Oftentimes during that same period of time, my position's probably going to be a little bit depressed relative to where it was. Now, if we've got a massive risk and it's not a position that we're holding intentionally because we believe it's a fantastic long-term investment, then getting out of at least some of that position makes sense. And using capital losses from other positions to offset can certainly make a lot of sense to resolve that concentrated position. The second opportunity there is use the loss to offset a rebalance to a more appropriate model, which can either solve the risk problem or an asset location problem. So it's really about using losses, harvesting losses to offset gains that we are only in because they're too painful to stomach at a certain point in time. Now, of course, there are cautions. First caution is wash sale rules. We got to make sure we're out of that position for 30 days. And if we pick up another position, we want to make sure that they're not the same position effectively. So I can't go from, one S&P 500 index fund to a different S&P 500 index fund and expect that to avoid wash sale rules. Maybe I go from a mutual fund to an ETF. Maybe I go from a specific sector fund to a broad-based fund. Those are probably more in the acceptable range for wash sale rules. I'm not going to give you a bunch of detail on that. The second is blind loss harvesting. So in some situations, some circles, I would say, loss harvesting is talked about as this is a great thing, we need to always do it. Well, the challenge is, if I have a client who is likely to be in a 0% capital gains bracket for most of their life, and I'm blindly harvesting losses just to get those losses harvested, what I'm really doing is getting no benefit out of harvesting the loss, and I'm getting a step down in basis. Okay, so for many of those situations, I don't want to harvest losses unless there is a point where I can use those losses to offset gains. So it's not something we want to do blindly. it is exactly where those tax maps come in handy, is to be able to identify the situation where, oh, wait, I have a client who's in a 0% capital gains bracket. The third caution is a short-term capital gain on rebalance out of the alternate position. So if I'm buying an alternate position that I intend to hold for 30 days and the market turns around, it turns out that this happened to be the last leg down. And now we just get a fantastic run up for the next 30 days. Presumably, there's a reason I have a primary and an alternate position. Presumably, the better investment path for the long term is the primary position. And if that's the case, then I want to get out of my alternate position and back to my core asset allocation, my core positions, as soon as I can after the 30 days. The challenge there is if I get a massive run up in an asset class, I can be recognizing short-term capital gains. Effectively, I can end up trading out long-term capital gains for short-term capital gains, trading out preferred rates for ordinary income rates. That's not a comfortable position. So just being mindful of that 30-day window to get out, and whether or not it's going to make sense to recognize any short-term capital gain to rebalance out of those alternate positions. So that's 3, call them tactical opportunities that we can take advantage of by harvesting losses during a period of market decline. Now, if I take the other 2, I might think of those as strategic tax challenges. These are big picture. They're overall strategy. And if I haven't set the overall strategy first, if the client has never had that, then this is the place to actually start, because it'll make all those first 3 challenges so much clearer. So if they've never had an overall account strategy, we start there and then we populate the strategy with appropriate investments. In order to illustrate this, I'm going to use, this is actually our Income Insight software that I'm going to use. And I want to point out that most people, in the absence of advice, in the absence of using a financial planner who's got some experience with retirement income, most people will claim Social Security benefits as soon as possible. They use their non-qualified taxable account money to supplement, and they'll get into their IRA or 401k when they have to, either because they don't have other non-qualified sources or they've got RMDs. And if they have Roth money, they'll use the Roth last. So we call that the base case. And when we evaluate retirement income strategies and the value they deliver to clients, we think about them in 3 core metrics. Number 1, how long does the money last? Number 2, if the portfolio runs out of assets before the client runs out of life, what percentage of the client's retirement income need continues to be met in the worst year? We call that the income floor. And the final is the estate value. What's left over? And that's a present value net of any taxes, and it's in today's dollars to the people or causes the client cares about. So that's how we measure the efficacy of retirement income strategies. And then, of course, we want to make sure if we have a plan that's only good if markets are just normal, that's probably not a very good plan. So we're going to throw several stressors at them. A down market early in retirement, high inflation, Social Security benefits get cut, a long-term care need, or an early death. So that's what the stress tests are. So let's talk about that first kind of tactical tax opportunity. This one is a new asset location. So in this particular case, we're going to take the client's non-qualified money from moderate to conservative, and we're going to take the IRA, we're going to leave at moderate. And then we're going to take her IRA from moderate to aggressive. And basically all we've done here is we've laid these out in spending order. So we know that we're spending non-qualified money first. John's older, so we know we're using his IRA next. And we're going to use Jane's IRA last, so we're going to make hers a little more aggressive. And these are super simple case study type numbers. So conservative 60% ag, 40% SPY, moderate's 40% ag, 60% SPY, and aggressive is 80 SPY, 20 ag. So ultimately, when we make that reallocation, we have exactly the same risk. Literally, we have exactly the same overall asset allocation. The only difference is the accounts they're in and relative to the spending order. So in this case, client risk 15.3 on a quarterly basis, about 30% on an annual basis. So same risk. When we bring that into a plan, it actually creates about $20,000 of additional value. And that doesn't seem like a lot, right? That's $20,000 though in today's dollars, net of taxes. So in other words, that's like adding 20 grand to their bank account today based on one strategy that literally didn't change their risk at all. About 28. So I'm going to take a pause for a quick poll here. Do you currently use financial planning software? And this is going to become relevant because I'll talk a little bit about how to use a variety of tools. In my practice, we use other tools as well other than our tools. And what do you know? It kind of breaks down very similar to the way the overall market breaks down. A little bit of a surprise there. Got a lot of Right Capital folks and a lot of other folks. So exciting stuff there. Okay. So let's talk about a Roth conversions strategy next. So we're starting with exactly the same base case. So portfolio longevity, income floor, and estate value. Let's first explore, this is a strategy we call the Roth conversions to lifetime effective rate. So the lifetime effective rate is basically if I take all the money out over the client's lifetime, what percentage of all the assets did I lose to federal income tax? That's the lifetime effective rate. In other words, it's a present value measure of, given the strategy that I expect to use, what percentage of my accounts does Uncle Sam own? And the balance is what I actually own. So the idea of doing Roth conversions to the lifetime effective rate is that we'll take the base case and we'll say, okay, if you do what most people do, you take Social Security early, use non-qualified money, use qualified money, and use Roth money last, in that order. Do what most people do. What is your average lifetime tax rate? In this case, it was 11.79%. So now we're going to say, okay, what if we only do Roth conversions when we can get money out at a rate that is less than or equal to that 11.79%. So I might choose that strategy. And here's what we see. A little bit of improvement in estate value, 860 up to 882. That was our plan without, with just the Roth conversion strategy. So just doing some Roth conversions and changing nothing else in the plan. That's also about $20,000 of improvement. Now, what if I did a little higher Roth conversion? Rather than doing that, we call that first strategy the first do no harm Roth conversion, because the client's really never going to be in a position where they will have paid more than they would have had they done what everyone else does. So what if we just took that 11.79 and said, well, we're going to go all the way through the 12, kind of to match up to the popular literature. That does deliver a little bit of extra value there. See that 860 to 891. Where in the prior case it was 882. So an additional 10 grand. What if we go to 22%? Whoa, that really juices the estate value, but it also makes us subject to a lot more risk because now Uncle Sam isn't sharing in my downside. Effectively, that's the reason why this down market stress test failed, right? Is because Uncle Sam isn't sharing in my downside. And so 22% we would really probably consider as going too far. So let's assume that 12% or less is our target for conversion. And this is kind of the base value improvement that we get from just Roth conversions. Now let's say that we also implemented a Social Security strategy with those Roth conversions. You see kind of a major jump there. Now we're up to $150,000 of value rather than about $30,000 of value. It's a really significant jump by pairing Social Security with the Roth conversion strategy. And why is that? It frequently creates a greater number of years of perfect income flexibility where we just don't have anything that is forced on us. And as a result, we've got the ability to really architect the solution that's right for the client. It ends up allowing a lot more money to come through at 0%, and it adds both value as an individual decision to just the Social Security decision. And when I say a combined value, it also adds some risk management elements to the planning. So then we take the third step, which is reallocating for asset location. So this means then reordering the accounts such that money that's in my Roth is my most aggressive investment account. And that juices it by about another $60,000. So you can really see a progression, a process there. And that is start with the strategic things, right? Start with the Social Security strategy, then an overall account harvesting strategy. And then once we've done that, then we can allocate investments based on when we're going to use them throughout the client's retirement, which then gives us a really clear lens to be able to opportunistically manage the plan, right? So now when I'm doing loss harvesting, I'm doing it with a purpose in mind. I'm either doing it to free up money for a Roth conversion, to get out of a position that I no longer want to be in. I can just annually modify my Roth conversions based on how performance actually went in the year prior. You know, for example, if I've got a whole bunch of carryover losses and I can wipe out gains from that are expected in the next year, then again, I've got a lot more room before I start to encounter any of those interactions between different income types. So if you look, what were the conversion amounts that we did in that last case? Not huge conversion amounts, 12, 50, 67, 85, and then coming back down. Not huge conversion amounts. What's funny though is the gray bars are if we implement a Social Security strategy, how much conversion can we do? And the green bars are if we don't. And the reason is that Social Security just really gets in the way and creates some, when we take it early in retirement, and it creates those distortions where we're willing to deal with the distortions later on because of the tax benefit and because of the longevity insurance benefit that we get from Social Security, and the fact that we can get our accounts to kind of an ideal state when we plan that way. So that's one of the big drivers of the value that you see with a Social Security and Roth conversion strategy. Now, I mentioned at the very beginning how these effective marginal rates and managing those situations is what creates this tax efficiency over a lifetime. So this is the comparison of the base case versus the plan case. What you'll notice in the base case is at every point along the way, it's pretty inefficient, right? So in this base case, this is just the interest that's spinning off the non-qualified account. Because in the base case, we're using non-qualified and Social Security. They could actually take an extra 10 grand plus about 14,000 out without paying a dime in federal income tax. But they don't know that. The client doesn't know that. They're just happy they didn't pay any tax that year. You as an advisor know that that's a missed opportunity. Those are dollars that we could cause to forever escape taxation by converting to a Roth. And it would cost us nothing to do so other than the knowledge to go look for it. When we look at the plan case, you see we're going to get right up to the edge. And we're going to do that throughout the course of the strategy. So the second year of the base case, we're paying some federal income tax. We're in that spot where we've got some taxable Social Security. And here we've got taxable ordinary income, but it's just IRA withdrawals. Actually, Roth conversion. Same thing for the third year, same thing for the fourth year. You can see in all these situations, we're really targeting to make the most of how much we can get out of the IRA at a preferred tax rate. So that's really what this strategic concept is about, systematically evaluating effective marginal rates in order to target either conversions or withdrawals to take advantage of low tax costs when you can get them. And down market years are certainly opportunities to get some low tax costs, either to solve the tactical challenges or to reposition for an overall strategic retirement income plan. Now that said, that's quite a lot in 45 minutes. So I know there were quite a few of you who are on here to explore us and consider whether you're going to pick up the software. If you do, use that coupon code, RESPECT20, that's our web address. RESPECT20 will get you 20% off any of our software tools. They all start with a free trial. I highly encourage you, if you take a free trial, call in, interact with the support team. It's one of the things that our users say sets us apart from other financial planning software companies out there. With that, Lauren, do we have some questions that came in through the course of the presentation?
We do. Is the capital gain generated in the taxable year included in the taxable income to determine the taxable capital gains bracket, i.e. 0%, 15%, 20%?
Yes. So it's, for example, if I harvested, if I had a bunch of Microsoft at $1 basis, it's at 100 today, and I sold 100,000 this year, then yes, this year I would recognize $99,000 capital gain, and that's going to boost up. That taxable income.
Great. How does one draw less Social Security in a given year? Isn't it a steady stream once claimed?
For the most part, yes. So for the most part, it's going to be important to do the Social Security planning on the front end before clients take it. Now, there are situations, this year's an interesting situation. If you have clients that did have cash on the sidelines and had Social Security benefits coming in, with a COLA like this, an 8.7% COLA, if you've got a higher wage earner who claimed a little early, not at 62, if they claimed at 62, there's a whole other reason why you wouldn't want to suspend their benefit right now. But maybe they claimed at 65 or 66 or 67, and that's their current age. They can actually suspend their benefit and increase the, they'll be getting delayed retirement credits during the time period where the benefit is suspended. That can be really advantageous, both for doing some Roth conversions and because of the impact on the benefit itself. So a voluntary suspension does still exist. The caution is, if you do that, you're going to shut off any spouse's benefits that are being claimed under the record. So you just want to make sure you do that really only in a household where you got two people who are higher wage earners.
Great. This comment is from Chad, who is a Tax Clarity subscriber. Joe, I've been using Covism Tax Clarity software for well over 10 years, and I love it. It's helped me gain some of the largest accounts that I currently have. I even went and got my EA designation because I see the importance of tax planning. Love the software, but will you please separate the pension and the IRA withdrawal entry in the software? It's on two separate lines on the 1040, lines 4 and 5, but in the software, it's on one line, and it's confusing for the client, and it's more cumbersome to do the calculations because you always have to add in the pension income each and every time you want to modify a calculation.
I love it. Thank you. Thank you both for the comment and for the suggestion.
If a client really does not care about estate value, they're single and have no kids, how do you demonstrate the value of the Roth conversion?
It might not be valuable. So that's a great question. So a client is single, has no kids, and doesn't care about the money they leave behind. They actually may be better off, particularly if they have any charities that they care about, leaving IRA money, because when it hits the charity, it's going to be tax-free anyway. I'm not saying that Roth conversions make sense in every case. I'm saying that when they do, they can make a lot of sense. Really, I think the way you demonstrate it is, does a Roth conversion allow you to spend more during your lifetime, right? And we want to just make sure we set those base spending targets high enough, where we're on the verge of bouncing the client's last check.
Can your software handle installment sale?
It's a good question. No, it can't directly handle an installment sale. That said, there's two bits of functionality that are on the roadmap. They're a little ways away. One is to hold a specific asset and only sell it in a planned sale. That would allow us to do an installment sale. But no, as of today, it can't do an installment sale.
It looks like there are no other questions. So thank you so much for joining us today. You will receive a recording of today's presentation and a link to the survey in your inbox later. Please take a few minutes to complete that survey. Your feedback really helps us improve our programming. Thanks again for spending part of your Tuesday with us, and we hope to see you next time.